Welcome to episode 1 of the Allies on Pursuit podcast. I'm your host, Chad Kemp. With me today is Mick Simmons from Gradient Wealth. Welcome to the program.
Thank you, mate. Thanks for having me.
Thanks for joining me. And why don't you tell us a little bit about yourself? Gradient Wealth is a business and,
so
a good intro.
I've been doing financial advice for 10 years now. Yep. So 2016 is when I got my start. I started with AMP Advice, which is an acronym that the younger generations probably won't know, but definitely the older guys would know what that is. It was like a big financial advice banking firm from many years ago, much smaller now. But got my start with AMP. Was there for a few years, and then a couple of businesses later, I shifted up to Sunny Coast, beautiful Sunny Coast.
It's the best. Whereabouts do you live on the Sunny Coast?
We're in Aura, so we're west of Caloundra, which is a great place because it's sort of designed by Stockland. It's like a little bubble. They build it in a way that you've got everything that you need. You never have to leave, like the Truman Show. It's like a little bubble, but the kids love it. They do such a good job of like building parks and things like that. The kids
absolutely
love going to the parks. Yeah,
that lagoon, that water park they've got scheduled for
that's going to be
completion
amazing.
Within about a year. They were talking.
Yeah, that's going to be amazing, and it's a small bike ride away. So it's a great place to live. But made the move up here in 2020, just before Christmas.
Okay, So
we
6 years now.
Yeah, so we avoided COVID, the worst of COVID in New South Wales, and then unknowingly copped the worst of COVID in Queensland, which is a weird memory. Like it's all in the rearview mirror now. But so. And then a couple of jobs, different businesses up here with different firms, just sort of restarting a career, I guess you could say. And then in the last 4 months, started Gradient Wealth because I've been doing it for so long, for other people. I thought it was about time to sort of start doing it for myself, and
Well, that's interesting to me straight away because I think a lot of people who aspire for what they deem to be the freedom of self-employment would be reluctant to take that first step. Yeah. Because you're letting go of a safety net. Exactly. You're used to collecting a secure 9-to-5 income.
Yeah.
Usually your financial circumstances will be geared around that level of certainty. Exactly. How did you find, as someone who's in financial planning, that taking that step and getting into a self-employed situation like you have?
Yeah, exactly. It's I heard somebody say that a monthly paycheck or a fortnightly paycheck is one of the most addictive substances known to man.
Yes.
Definitely I felt it. We were prepared. We had, I guess in terms of, how would you financially plan a shift into, being self-employed? We had cash buffers and, 6 to 12 months of expenses and whatnot, sitting there ready to sort of help us through. So it wasn't too much of a worry from that angle.
Yep.
It was more about, and this was kind of one of the big reasons why I sort of made the shift, was because we're sort of at peak family right now where the kids, there's the most number of them, they're at their most needy, and they're sort of getting towards their most busy. So we're at peak family. And the flexibility it just needs to be there. We've got 3 kids, 2 careers, 1 dog. We're busy. So
that's a massive plus. I think that was one of my biggest motivators as well. When my life circumstances had changed, I had a fairly demanding corporate position, and it was in Brisbane as well. So I was driving back and forth on the Bruce Highway every day. I'd leave at 5:30 in the morning to beat the traffic. To beat the tradies who are out there beating everybody else at 6 a.m. You got to get in half an hour earlier to get ahead of the tradies, right? And you get to Hamilton. For me, it was Hamilton at, whatever time that was. Get a quick workout in, work till 6:30. Battle the traffic back to the Sunshine Coast, and I'm putting my kids to bed at 8:00, writing a story, packing my bags for the next day.
Yeah.
And very little time to actually live my life. So
yeah, exactly.
The motivator for becoming self-employed for a lot of people, I'm sure, is that having that accessibility as a father or as a parent to be able to look after our families.
Yeah, exactly.
But on that comes with a certain level of risk, and it sounds like you, obviously being a financial planner, you were pretty considered in your approach to that from the beginning.
Yeah, I think so. I sort of had, probably a few months run up on it, designing how it's supposed to go. The other thing is that, I guess it never goes perfectly to plan. And part of a good plan is knowing that the plan will have to adjust as you go. So, so we're sort of 4 months in, we're doing well, and things are sort of, spinning up and getting busier. The line between, marketing and sort of going out to the market and looking for clients versus holy crap, I'm so busy, I don't get a chance to breathe is quite thin. So that's kind of where we're at now. And keeping the balance with like family and flexibility and everything as business gets busy, which is always the goal to get busy.
Yeah.
How do you get busy but then stay efficient so that you're not, losing one for the other? Yeah. So it's a balance.
Yeah, well, mate, I know a lot of, the listeners that we are, searching to connect with will definitely be able to resonate with the challenges and the, sort of story that you're putting forward here. I think, though, to keep this on point, let's talk about financial planning in general. Would you give an overview to somebody who knows nothing about financial planning? What is this domain that you live in, and how do you add value to, people, like I said, like if the listeners here are self-employed people. We're talking people in that age bracket between sort of mid-30s up to their sort of 60-plus retirement, getting close to retirement. I know that you would be seeing a lot of people within this band.
Yeah, absolutely.
What do you do? How do you add value?
Financial planning is basically for answering the big questions that you can't answer for yourself. There's so much information out there, even more so now with AI, that people they've got access to facts. I think it's more about sort of bringing all those facts together in the right way and then planning out what you actually want to do. So financial planning starts all the way at the start, and it's quite a process. It starts back at goals, and it sort of says, well, what do you actually want to do? What do you want your life to look like? Because the vast majority of goals are financial goals at the end of the day. I mean, even if you want to spend an hour in the park, meditating, to reach enlightenment and sort of cope with day-to-day life, people in that age bracket, that's time spent, and time spent, has a monetary value attached to it still.
That's the cost of life.
Yeah. So even the most, non-financial goals still have, some sort of price tag to them. So getting all the goals set out at the start is probably the most important thing, because then, if you've got a professional with objective tools and know-how and experience that's going to go, right, what do you do? What do you look at to sort of aim for those goals? That's a huge firepower. You want to aim it at the right stuff.
Yes.
I think too, part of like a good advisor should be able to assess your goals and sort of say, well, are they actually goals? Like sometimes people come to me and they say, I really want a self-managed super fund.
Yeah.
Like it's a stepping stone or like an achievement sort of thing.
Yeah.
And I can sort of tell like, oh, maybe that's not the actual goal.
Yeah.
Easy to ask then why? Why do you want
it's the why that you're sort of trying to flush out.
Yeah. So you can zoom out on goals to sort of say, well, why do you want that? Several whys later, you're probably going to get to the actual meat of the goal. And it's like, well, I probably want to, grow wealth and retire one day and enjoy my life and those sort of things. That's where the goal needs to start with financial planning.
Yeah, that makes sense.
Because self-managed super fund, it's great for the right people. It could be way too expensive for the wrong people. That's more of a solution mode, which is further down the process.
Yeah.
Assessing what you want to do in life, when you want to do it, time and money-bound goals allows you to put them on a map. And so you've got your starting position, then you've got where you need to be.
Yep.
Financial planning just joins the dots.
Yep.
And so it should be not just investments and things like that, but it should be everything: tax, cash flow, what your career path looks like. How do you structure, building wealth in the right vehicles, so that you're not bleeding costs and tax on the way, but also you've got the end in mind as well. Who owns what? What do you invest in? How often do you feed it? It all comes back to the trajectory that you want to be on. that'll inform, the solution that gets built. So, yeah, so in a nutshell, that's kind of what financial planning's for. And then I guess once you get to where you'd like to be, and it often centers around retirement. I think the older generations think more about retirement in a different way to the younger folk that I'm meeting now. Yeah, retirement, it's more for the older generations, it's pull up stumps, I'm done, get me the hell out of here. For the younger guys, they mostly use the terminology that they want options.
Okay.
And I resonate with that because they sort of acknowledge that they don't want to just go cold turkey when they get to that age.
Yeah.
It's more about, well, if I can take layers of work off, go back to 4 days a week, 3 days a week, or you can see in their mind that they're adjusting the mix rather than just like, I'm done, let's get out of here. And so from that point on, the objective tools come back into the picture, and you use modeling to sort of say, well, how long is your money going to last, depending on how much you want to spend, what you want to do, holidays, travel, gifts to the kids, things like that. It'll model out how long your money's going to last. If you outlast your money, then there's strategy needed to close the gap. If your money's going to outlast you, then it's more about, well, how do you hand that on to the next generation without giving too much to the ATO, and how to do that. Do you want to do it earlier or later, or once you've passed away? Like a legacy.
From that consultation perspective, that sort of needs assessment, that goals assessment, and then that modeling you talk about. So far, you're giving them insight as to why a sound financial plan will be important for them.
Yeah.
I think a lot of people would be nervous about engaging someone in a service like yours because they'd worry that initial stage might be costly.
Yeah.
I would guess from just knowing you, you're a pretty reasonable character.
Thanks, mate.
Yeah, no, that's why you're here, man. I thought that as soon as I met you, even a couple of the business partners that I've got, the people that I deal with regularly, when we talk about financial planners, a lot of them are just very keen to sell you on their products. And I think one of the first thing you mentioned to me is, look, I don't deal in a lot of those products. I am more focused on these plans and actually helping people achieve these goals.
Yeah, strategy.
The strategy, right. So for me, if I was somebody who was maybe interested in learning more about what you do, what kind of expenses am I looking at to have that first? Is it a reasonable expectation? I'm guessing it's not expensive.
No, I don't think it is. And you have to think about it, I guess, in terms of the value that you get back. So in advice, there's sort of two hemispheres to value. There's the tangible stuff, which is, costs saved, premiums saved on insurance and things like that, tax saved, and sort of knowing in an academic way that you're going to achieve your goals. That's something you can feel.
Yeah.
And you can put a dollar sign to that sort of thing, and people connect with that much quicker than they would with the other side of things, which is the intangible side of stuff. So it's like having a professional in your corner who you can call if you get something in the mail from Centrelink, or a tax rule you've heard on the TV or something. You can call your guy and say, what does this mean for me? If that guy's worth his salt as an advisor, he probably already knows. And sort of having like a professional on your team that can help you navigate changes as they happen to you, changes to rules, tax, all sorts of things, navigating complexity and volatility so that you've still got the whole plan in mind rather than just sort of knee-jerk reactions. There's two angles to, I guess, how to get paid in advice. There's the old world, which is it's mostly gone now, where advisors were salesmen, basically.
Yeah, okay.
And they were vertically integrated with banks and insurers and things like that.
One that comes up a lot.
Yeah, exactly. Where there was commissions baked into things underneath. And all sorts of, conflicted incentives to sell you more or put you in a product that maybe isn't the right thing for you.
Yes.
The industry was born out of this sort of thing, which is a good, 30 years ago now.
For me coming up, I come from very modest upbringings, and
so
for me looking at, you look at some of this and you're like, oh, this this seems obscene to me. This doesn't have value.
Yeah, the pub test.
Yeah.
Yeah, exactly.
Yeah. What is the pub test?
It's if you told your mates at the pub over a beer that, you know, what you're reading on the page, they would either go, oh yeah, cool, that sounds good, or everyone would balk and you know, be up in arms like, whoa, that doesn't smell right. Like sometimes you can just get a sense of things.
I like that. Yeah, I've never heard of that before.
Yeah, the pub test.
Yeah, that's cool. Yeah, that's very cool.
Financial advice is a profession now, instead of just being a sales function bolted onto a bank. It's now a profession. It's got its own ethics board. It's overseen by several parts of government. You know, it's becoming, I guess, entrenched in financial services as its own thing, and then sort of rising to the challenge of, well, if we want to be a profession, we have to be professional, but then, you know, build that profession along with us as we go. Yeah.
Yeah, that's great. Well, I think to try and stay on point, because I know we've got limited time with you today, and again, I'm really grateful for you to take time come in here and talk to me like this. If we were to think about small business owners specifically, you know, and you being one as well, you know the challenges. At this early stages, it's very much about ensuring that you've got, you know, a really stable sort of cash flow. You really focused on your funnel. You're really focused on ensuring that you got a strategy in place that will start to increase that certainty and increase that stability. And a lot of people are afraid to make any significant investment in that period, because you spend X amount on this long-term project. That's going to pull away from maybe next month's meal ticket. A lot of people are thinking, you know, I like that. I like having cash in the bank. I like having things I can touch and release immediately. Yeah. In case
something happens.
In case the funnel dries. In case you know the people stop calling or stop inquiring.
Yeah, exactly.
In your opinion, at what stage should people start feeling comfortable enough to start looking long term? You know, in that sort of overall picture.
I think you've touched on a good point. I mean, having the cash buffer, I guess, inside the business, and also probably personally, you know, for the family and yourself, is two good base layers. I mean, that's not you know, advice that you would pay somebody for. That's pretty straightforward stuff, but it's going to be hugely powerful when the dry months come along, because you'll feel more confident, you'll feel more comfortable. You know, family stress will, you know, remain managed. And you can sort of look through it then, and you can keep your eye on the prize almost. But I guess, you know, once the business is sort of feeding itself, you're not tipping money in, etc., and it's becoming more self-sustainable, you'll probably feel, you know, depending on the nature of the business, you'll feel super busy. But a lot of the time, a lot of that busy can be just spinning your wheels a little bit. So I guess once you feel like that's in the rearview mirror somewhat, and you can start looking, you know, further ahead comfortably, once you can look sort of a year ahead, I think you're in a good place to start thinking about whatever your next move is, whether it's, you know, reinvesting some of that cash flow into the business to take a new step, or to add scale in some way. You know, in terms of adding scale, some of those things can be like wobble points, where you sort of, you know, you have to take a large step forward or a couple of steps back. You know, you take on extra costs for, say, a staff member or something like that, which offers you the scale, but you have to actually get through that period where
exactly what I'm talking about.
Yeah, you've stepped back in order to step forward at some point. The shorter that period is, I guess, the better. If you can plan ahead for what that period looks and feels like, maybe you expand cash buffers for that period of time, or that financial year, say, depending on how fast you want to grow things. But then there'll come a time where, I guess, you know, you'll start having money building up inside business. And then the question becomes, you know, how do you get your hands on that tax efficiently? How do you sort of extract value out of the business and start building personal wealth? Because that's the whole idea at the end of the day, is to do good things for good people in business, and grow that, and then transfer it into, well, you know, everybody, even business owners, have got their own goals. You know, they want to be building for their own lives and their families and whatnot. So how do you transfer that, you know, out of the business into your own name, tax efficient ways? What vehicles should it be in? Things like that are common questions. Yeah.
Well, that's a lot of people understand that trusts are an important aspect in that sort of framework, that future growth framework. But people like me, I deal with people in trusts every day. I understand how to put forward an application. I work in the finance sector. I'm a mortgage and finance broker. Yeah, I understand the intricacies of submitting applications that involve trusts, and I understand the structures and the beneficiaries, and I understand the benefits.
All the bits and pieces.
But to somebody coming completely green, not having any idea why these things why they even exist, could you give a sort of high level sort of overview? What is a trust? Why do I need one?
It's definitely something that's on the radar. I mean, zooming all the way out, a family trust is a tax entity in the Australian tax system, just like a self-managed super fund, just like an individual. So yourself is a tax structure in the Australian tax system.
Yep.
Each with their own different tax rules, tax treatment, rules on how money can enter and exit a particular entity. Family trusts have got their own rules, etc. Look, it's something to put on the radar simply because it offers the opportunity to stream income to multiple beneficiaries so that it's not all lumped in on perhaps, the director or business owner or someone that's self-employed. If you're copping all of the income, you're getting taxed, up to 47% at the top rate. Versus if you're investing and generating income inside a family trust, you've got the option to stream that based on the rules of the trust. If it's a discretionary trust, you can stream it to whoever you like, so long as they're beneficiaries in the deed. And that can be tax advantageous to you to sort of minimize income tax. But yeah, it's a vehicle that can hold assets. It can borrow. It can feed you, through your days. It's not the only solution, I guess, because if you're streaming income to someone that's already got income,
that's what my first thought is.
Yeah, they're going to get taxed as well. So you're adding income on top of different layers here and there. There's strategy in it, but it's not the only answer.
Can people stream income to minors, for example, people under the age of 18?
They can if they want to. The first $416 of income streamed to a minor is tax-free.
Okay, $400. Wow,
$400.
Man, the government. I'm always astounded how generous the Australian government is.
You'll love them, mate. You'll love them.
Absolutely.
After that 416 up to, I think it's about $1,200.
Okay.
The tax rate is 66%.
Okay, so it's not advantageous then.
No, as soon as they turn 18, the kids, they have access to the tax-free thresholds of adult tax rates then. So things can change from that point on. I mean, if they're working at, McDonald's or KFC or something and earning an income there, then it's the trust income is just layered on top of that.
But I can't help but wonder, if I had the choice between going through all the rigmarole, setting up trusts just to funnel money to my son who's 18, for example.
Yep.
Why wouldn't I just run him through an ABN and have him contract to my company and pay him that way? What would be a reason you to choose a trust over not choosing a trust in a situation like that?
I think it probably comes back to having control and visibility over the whole strategy. So everything that's inside the trust is controlled by the trustee. If you're the trustee, you've got complete visibility over everything that's happening, and you get to sort of, I guess, decide on how things are managed, where income goes, what assets are chosen inside the trust. Sometimes as well, people use family trusts as a sort of a wealth transfer vehicle.
That was going to be my next question. So tell us more about that. Because I guess, is it maybe less about income and more about assets?
It could be both.
Okay.
Yeah. So if the idea is to transfer wealth onto the family, often it's a living legacy, I guess. So you're still alive and you want to see the kids, benefit from what you've created, whilst you're there to see it and watch them enjoy it. That's a real thing. I talk to, elderly clients who are wanting to do this sort of stuff.
Yeah.
Family trust is one of the ways that they can do that. There's other ways to do it as well. There's ways to sort of manage that inside a will. You can feed the will with super and income streams. Lots of different options. Education bonds is another one where it's a completely self-sustaining investment, I guess, account, and it can be shifted over to the kids at a predetermined date, or when you see fit. Doesn't create a tax problem for the kids, but it transfers wealth without transaction costs, inefficiencies with accounting and things like that. It's just a form. So there's lots of ways to transfer wealth in the end. And I talk to a lot of elderly clients who, it's becoming more common now that you sort of ask them questions around, are there goals for estate planning? And they typically say the kids are fine. Their kids are fine. They got jobs, they got houses, mortgages. They know what they're doing. They're going to be okay. The bulk of their worry is for the grandkids.
Oh, wow.
Yeah, so the wealth transfer kind of leapfrogs, the next generation.
Yeah, wow, that's interesting.
Sorry to be the bearer of bad news for some of those people, but
honestly, if we look at the state of affairs for the grandchildren in this case, and you think about the cost of buying a home now, a lot of these people would feel homeless or helpless or hopeless when it comes to entering the market, entering into this economy.
Yeah,
I can understand why they'd want to.
Yeah, this is the worries. Yeah, for the elderly clients there, and they don't express those worries, explicitly, but that's kind of what they're saying. They want to look after the grandkids and ideally see them enjoy, part of what they've gifted them before they're gone, sort of thing. Yeah. So transferring wealth is a huge, I guess, financial advice element, to people's plans, because as we go on, property has increased in value, for decades and decades. The super system is also, it came in the early 90s. Before that, it was kind of attached to employers and not as portable and things like that. But because it's become, from the 90s onwards, structured, employers have been contributing into it as per the rules. It's built huge nest eggs for people. So people today have a lot of wealth, and the question then becomes, well, how do you hand it on in the right way? Yeah,
that's a good question. When we talk about the right way, I think a lot of the first questions will come to mind is, how do I make sure our generous friends at the ATO don't take the lion's share of this wealth that I've been able to secure? Is that a big part of what people ask you about?
They don't typically ask me, but that's something that I flag with them. Yeah.
Yeah. Okay. Wow.
Yeah. So most people wouldn't know that, especially for super. If you've been building your super for years and years, it's all ice cream at the end of the day. Like, you've been building that balance up. Underneath that balance, there's actually two flavors of ice cream. There's taxable and tax-free. The tax-free component is not a problem. The hint is in the name, I guess. The taxable component, if you're in a couple and both of you were to pass away and you've got superannuation that has taxable component in it, your kids, adult kids, will pay up to 17% tax on that component. So the ATO gets their hands. It's not an estate tax like in the UK or something like that. But the ATO can get their hands on that. So there are strategies to wash that away. Whilst they're still around, they have to be here. In the lead up, and it might take several goes of strategy to wash it all away. But effectively, you're saving tax on the final estate figure that the kids will get. So that's just one angle.
Well, I want to zero in on something you said. It might take a few goes. We're talking about people who, unfortunately, have lived a long life there, at that golden sort of stage, the sunsetting of their time on Earth, they're starting to consider, real world possibilities. They may not be around for a lot longer. I'm guessing time is a major consideration in this, and because if it's going to take a bit of forethought, and they've only got limitations on how much time might be available.
Exactly.
What are we talking? Like, we don't want to wait till the very last day and then quickly sign a form here. We're talking how many years should we be thinking about this in advance at a minimum, if we want to make sure that we, like I said, you maximize the amount of benefit to to your grandchildren, for example.
Yeah, exactly. You want to start as early as you can. And it's not for the obvious reasons, but it's because of the rules on money coming out and going into super.
Yep.
Back to the super example, up to the age of 75. After that, you can't put money back in. So there's the strategy to wash away that taxable component is to take money out and back into super, but you can only do that up until 75. So and you can do it in like annual amounts, or you can bring forward several years worth. That then creates a sequence or an ideal sequence of, do you do 1 year, 3 years, wait 2 years, another 3 years, that sort of thing.
Okay.
So you need to decide on that sequence years in advance, because you want to maximize the perfect sequence to wash as much of this as you can before you're 75.
Okay.
So thereafter, the strategy kind of has to change. But I guess advisors will bang on about superannuation. I'm doing it right now. Simply because it's one of the lowest tax vehicles to invest in Australia. So the tax rate inside super is only 15%.
Okay.
Versus what it might be in your own name, investing as an individual could be up to 47. So building wealth inside super, it's got less friction. It's got a chance to grow faster than investing in your own name.
So can I ask you a little bit about that then? If you were self-employed and you're in that sort of, let's say you're in your 40s, 50s, you're looking at options in terms of growing your investment portfolio. You might be thinking of taking out a loan on just investment properties under your personal name versus setting up a self-managed super fund and throwing all of your strategy into that channel. What would be your recommendations in that sort of case? Is it worth doing it that way? Like I've talked to a few people recently are losing hope that even investing in property is a sound choice right now because of the land tax laws, the capital gains taxes, and all of the reasons, all these sort of disincentives that the government, again, our good friends have set up to sort of, I guess, curb that demand and inflationary pressure on the market. Is the self-managed super fund a good solution for people who are a little bit nervous about that, or does it have its own inherent risks and sort of challenges that need to be navigated as well?
There's a fair bit to unpack there. So I guess self-managed super for the right people for the right reasons. It's in terms of complexity, it's up the top end of how bells and whistles type of super vehicles. Down the bottom end, you would say, is the industry funds and these sort of funds that advertise on the TV. And there's different types of funds in between. But for the right people for the right reasons, if a client is looking for control and visibility over how things are invested, what it's invested in, self-managed super can make a lot of sense. If it's got to be property with borrowing and borrowing to invest inside self-managed super can really amplify gains over the long term. It can amplify the downside as well, which is something everyone's got to remember.
I spoke to a guy just the other day. He's a good client of mine. We've financed a few properties for him, and he's going, I really want to do a property a year. And then, just yesterday, he's going, man, these new, the government's talking changes to capital gains tax. They're talking, of reducing the discount for capital gains benefits tax. I think you can maybe shed some light on that. But he's going, I'm just starting to feel like maybe this isn't the right avenue for me. I'm thinking self-managed super might be a better solution. What would you say to someone like that?
This is an interesting concept too, because I guess, zooming all the way out, if you own a home and it's on land, that land is technically owned by the Australian government, because they can rock up to your door and say, well, well done for owning your own home. Congratulations. This is your part of the earth. But actually, we're going to add some tax to that. Pay us tribute, I guess, is what you would say in medieval times. And if you can't say no, which most people can't, you're then forced to, pony up and start paying. So the question then becomes, well, do you really own that property then if someone can rock up and request rent effectively. So that's a real concern for people, I think, even more so now. I think it's sort of becoming increasingly politically charged, I guess, is the idea that the wealth gap in Australia is large and growing, and it's quite noticeable in property. And so landlords, I think, they do a fantastic job for providing property and a roof over people's heads for people that can't afford a home.
Yep.
That's what renting is.
Yep.
So we need landlords.
Yeah, absolutely.
Yep. But I think it's becoming politically acceptable to maybe target them in a way.
Yes.
Where they're an easy scapegoat.
Yeah.
Because maybe they're linked with wealth. Maybe, you can't pick a property up and move it somewhere safer either. You kind of, you're tied to the street and the land that it's on.
Yes.
You can't run away with it. And so it's, it can be taxed if the government decides to do so, and they can change the rules. So yeah, it's I guess it's a concept that people are sort of coming to grips with slowly. It's very slow moving. But yeah, it's real. It's a real thing. So I guess, thinking about wealth in the ultimate long term, not just for the rest of your days to retirement, but if you're trying to build, a legacy or, dare I say, a dynasty sort of thing, wealth that can outlive you, your kids, your grandkids. The idea, you have to think about wealth with extra layers to it, like people have probably had to do over history, is that how do you protect that wealth from things that you don't know might be coming, changes in rules, government changes, things like that. History has sort of shown us that, you do have to think really deeply about where you hold that wealth and is it portable? Can you run away with it? If you can put jewelry, in a bag and exit a country, people have had to do that over the years. You can't do that with property. You can't take it with you. So
yeah,
it's stuck here on the street that you bought it on, and taxation might come after it if it's politically, appealing. There's a big cohort of Australians out there who think that, the wealth gap might have been created in part by landlords, that they're bad guys or something like that, which isn't the case.
Yeah, that's sort of, they're just greedy. They're buying up all the properties. And, that drives scarcity, and then what the scarcity causes inflation. And
this sort of thing.
Yeah.
So I think they can be an easy scapegoat in a way. It's just something to think about, I guess. Yeah, and I guess it will express itself in terms of additional incremental tax that just pops up, and you've got to pay this, and we'll reduce the general discount for capital gains on investment properties, so it's disincentivizing, like you said, speculation, and more of a tax grab as well.
Look, at the end of the day, I can fund a property under your individual name, and I'm perfectly happy to work with you on your self-managed super fund strategy. We can fund both. But I can't tell you which is right for you. That is where someone like yourself will come in.
Yeah, exactly.
So if someone was coming to you, and again, you don't have to give all the advice today. I'm not here to press you for free advice. But at the same time, if someone's listening to this and they're like, that guy looks like someone I should speak to. He seems to know, what he's talking about.
Yeah.
What would you say from a general perspective would guide that decision? So that they could make an informed decision. Does that make sense?
Yeah, it does make sense. So I think some of the things to think about, property inside super versus property in your own name, straight away is the tax.
That's what I thought.
Yeah, which is not just the tax along the way, but the tax at the end as well. Because I guess the idea will be one day that, the idea that you can't take a brick to Aldi and buy your groceries with it says that eventually you'll have to sell that property. You can't sell it in pieces, so you have to sell it lump sum. So there's a big tax event in the future.
Okay, yeah.
Yeah, so that's something to think about.
So it is a significant tax savings by doing it through the self-managed super than doing it as a personal investment?
Yeah, so one of the bigger differences is that in your own name, the general discount on so far, if they don't change it, the general discount is 50% reduction of the gain if you've held it for longer than 12 months.
Okay.
Inside Super is the same rule, but it's only a third.
What does that mean?
Yeah, so if you've got an investment that's grown in your own name, you sell it and you've triggered a capital gain. Say the capital gain is $100,000, just for example. Only 50,000 of that will count towards your taxable income in your own name. Mm-hmm. In a self-managed super fund or inside a super fund, that same $100,000 would it'd be 66,000 that would count towards the taxable income. So the discount is smaller inside super. It's only a third, whereas in your own name it's a half.
That's actually a disadvantage then of the self-managed super fund, is it not?
Yeah, it would be, but then you've got to also consider the taxable income throughout owning it. So property is a long-term investment.
Yep.
If you own that bad boy for 20, 30 years inside super, it's likely to grow, very likely to grow.
Yep.
The rent is taxed at the super tax rate,
which is 15%.
15%,
as opposed to somebody's getting 30 to 50, 47% or something.
Yeah, yep. Exactly. So there's cumulative tax incentives.
Yep.
Different tax outcome at the end.
Yep.
These are the things to consider.
Okay.
The duration is one of the main things that will inform that. But like I said, property is a long-term investment, like any sort of growth investment. These investments go up and down in value in the short term, but if you zoom all the way out, they generally go up and down in an upwards fashion. So these are growth assets. Property is a growth asset alongside shares, infrastructure, crypto, whatever you want to call it.
You bring up something that comes to mind. Then I think liquidity would be a big factor as well, because once you tie it up in self-managed super fund, it's pretty locked in. It's a lot harder to release those funds, like because you said something about can't take a brick to Aldi, right?
Exactly.
I think, when there's the tax differences that are being a factor, and it sounds to me that you can help people look at the models over a fixed period, 10, 20 years, whatever it happens to be.
Yeah.
Explain to them those taxable differences, notwithstanding any significant changes to tax legislation.
Yeah, spot on.
But at the same time, they need to factor in, if you put that money there, it's not as easily accessible than if you did happen to buy an investment property and think 3 years in, you know what, this isn't going to work for me. I need to release those funds. I need to sell that property. I need to get back into a different, maybe just invest in a different area.
Yeah, exactly.
That would be another factor, I'm guessing.
Yeah, which comes back to the goals then as well. So if there was something in the goal set that indicated, well, maybe you're going to need money in a few years' time, you wouldn't chuck it into super for a 25, 30-year strategy. You'd keep it outside and invested, in a different way. Another thing too that people, sort of clients that I meet with, that want self-managed super particularly, it's because they've got a building background, or they're quite handy, and the idea is then to buy the worst house in the best street, do it up, with lots of upgrades and renovations and things like that. If you've borrowed to invest in that property through a self-managed super fund, some of the things important to remember is that any work you do or any upgrades you do to the house could be considered contributions, which have their own caps. And so you've got to have a monetary value of your time spent on that property, which can catch people out, because if they go over the cap, then there's all sorts of tax, outcomes and things like that to manage. The other thing too is that you can't change the nature of that property if it's under a borrowing arrangement inside self-managed super. So you can't add a bedroom, you can't add another story or whatever it might be. There's different rules that most people don't know about, and if they get all the way down that track, they've put money into super, they've gotten ready, got the house, and then they go to work on it and realize then, oh crap, my whole idea isn't going to work. It's hard to walk all that back.
That makes sense.
Big time.
That makes a lot of sense. So that's interesting. And I think, starting now, the more I talk to you, the more I realize, I think you referred to yourself as like, I've got a guy, if these things, like I said, I get a letter in the post and the ATO's demanding X, Y, Z. Or if, like I said,
an ugly letter.
Where you really fit in is if you align yourself with people as they start looking down the path and as they start really considering their future and those goals that you had established in the early days, without intruding too much on their lives, you can just sort of align next to them and say, we can help just be that little voice that sits on your shoulder to say, hey,
exactly.
let's do it this way. Here's some of the things you should do, as opposed to the devil that's always on the other shoulder going, let's blow this money on travel.
You do need that car.
You definitely, absolutely, man. More tattoos, brother. Let's go. That jet ski is definitely worth the money spent. Yeah. Okay. Cool. So, if someone's I guess talk to me a bit about Bitcoin and sort of cryptocurrencies and the rage. Sure. Everybody's, I don't know. It seems to me the hype has sort of died down in recent years. I think a lot of people sort of saw the big boom of this new technology, this new avenue, and I think, have we seen the sort of heat come out of that market? Is this something that a lot of people should still be considering in a balanced portfolio? What are your thoughts?
Yeah, absolutely. It's an asset class now. So I guess if you refer to the hype cycle, there's the initial sort of boom of a new technology. It comes out. Everybody wants to have a piece of the action. The general idea then is that this technology can just solve every problem you've ever heard of.
Yeah.
Everyone goes bananas. And then, of course, no technology can solve every problem. Everybody realizes, that it's not a panacea. That's the fall. And then eventually in that dip, this is the hype cycle I'm referring to. In that dip is where the actual tech gets put behind the scenes. It gets put into, good use cases. And then from there, you actually see real growth.
Okay.
Yeah. So that's kind of where I think we've spent a lot of time in the last few years for crypto. So another important thing, Bitcoin is more money, or internet money. Digital gold is the other terminology. Crypto, which is the rest of the asset class, is tech.
Okay.
Yeah, so that's probably the best way to think about it. The tech is getting adoption. So behind the scenes, as markets sort of cool and go off the boil, that tech is getting built into stock exchanges across the world, bond markets. Governments are sort of floating their debt instruments on blockchain rails. They're putting blockchain rails into a lot of the banking system in some countries. So it's getting used, and that's the blockchain is the tech.
Yes,
that's the killer use case, is the distributed ledger of information, so that no one can toy with it, and it's publicly available. So that's the tech that's underneath, and it's getting put into lots of different things around the world with scale, which also then makes it an asset class for investors like listeners and you and I. The volatility is still there. So absolutely, it's hard still for the average punter to invest in the absolute risky, crazy tail of crypto.
Yeah.
There's still scams, there's still crazy volatility down that end. But if you come all the way back up to dare I call it blue chip, crypto and Bitcoin, that's the stuff that's getting used. Ethereum, Solana, this is the stuff where the tech is actually getting used in the real world, in the real economy. It's got a use case. It's not going away. It's a thing. So if that's got a bright future, there's definitely reason to have it as an exposure in a portfolio. It's funny to think, though, I meet a lot of elderly clients as well, and they're also just as interested in Bitcoin and crypto because they've heard about it. I guess their grandkids or they're all talking about it as well. So they ask me, should I have some of this stuff? I'm like, well, I have to give the boring answer. It has to come back to goals and risk profile and that sort of thing. No one wants to hear that. They just want the Bitcoin. But so it could easily form a part of a portfolio for any type of investor, just sized right.
Yeah.
If you're sort of in your 50s, 60s and you're not looking for that rapid, crazy, gamble sort of growth, maybe it's a small allocation. But if you're, in your younger years and you've got good income that you can replace that money, if it evaporates to zero, you can replace it again. It's definitely something to consider. Yeah.
Yeah. Wow. That's, actually, you reminded me of one of our earlier conversations when we were getting to know each other. And, I was sort of talking from that sort of generalization. Like, let's just say, look, I'm just super conservative about the way that I approach this. I've got my money sitting in a super fund, but they give me a choice. the sort of higher risk, higher volatility option, or the low risk option there. And I think what really stood out, and I think was interest, like what actually changed the way I looked at it was, if you have more time on your side, high risk is actually the maybe a more suitable option than low risk for people who are, they're in the sort of later years of life. Risk adverse, being risk adverse is probably wise for them. So Bitcoin, when you're talking crypto and all that sort of thing, those seem to me more volatile markets. Is that a fair assessment?
Absolutely, yeah. But there can still be space for it in a conservative portfolio. It's just sized, to the tiny amount.
Yeah, okay.
Or an amount that makes sense.
Yeah.
And it's not just because it's crypto. You would do that with all of the growth assets. So in a portfolio, you've got the defensive side, which is the boring stuff: cash, fixed interest, term deposits, credit, bonds. On the growth side, you've got the stuff that goes up and down in value, but generally, up over time. Shares, infrastructure, Bitcoin, crypto assets, and things like that. Property isn't the other one. And so when you're designing a portfolio, you have the risk level in mind, and the mix of those two things is designed to meet that risk level for a particular client, but also cater to other preferences. There could be things like sustainability investing, or ESG, which is environmental, social governance investing, investing for change, I guess you could call it. That could be a strong preference for a client. So if you can add that layer in to the mix whilst still also targeting the right amount of overall risk and diversification, that's probably a good start for
that's interesting.
Portfolio construction.
Yeah.
But you're right, like back to the timing, if you're just trying to choose an investment option in something like super, if you're 30 and you've got at least 30 years before you can touch this stuff inside super, unless they change the rules in the meantime.
We always have that caveat.
Yeah, absolutely. By the time you get to 60, that's 30 years of investing, compounding that you've got ahead of you. It makes so much sense because you can't touch it. So all you've got to do is feed it, or your employer is also feeding it. So it makes sense to take some risk because that generally drives growth over time.
Yeah, wow. That's interesting. There's so much came to mind that I'm actually like trying to go through in my head. What should I ask him about? Well, going back to what I'd mentioned in the beginning of this episode was that, like I said, I think most people who have a responsible view of their future know wealth accumulation is important.
Yeah.
But because there's so much going on, because the language as well and the terminology and the jargon can be often confusing for the average person, I think a lot of people just switch off naturally. It just sounds too hard. They just go, look, the government's looking out for me. I've got my super set up. It's all too hard.
Yeah.
But at the same time, what I've gathered and what I even understand from my own life and experience is that, this isn't something you can ignore. This is something that you need to take seriously, especially if you're a family person. You've got people that rely on you. You've got those grandchildren in either in the present or the future that you have to consider while you're sort of on this journey. And again, I think a lot of people would be nervous about reaching out. If we said to the people listening to this podcast, hey, listen, Mick's a great guy. He's easy to talk to. He knows his stuff. What would be a good first step for them to sort of reach out and get that, again, put that toe in the water with you?
Yeah, exactly. Look, the first place to go is to the website. It's gradientwealth.com.au. Very easy to book in for a 15-minute intro chat. And that's just a chance for us to have a chat about where you're at, what you're thinking, if there's any burning issues, top of mind, we can talk about it. And it's sort of an intro, like a chance to also consider if there's value in advice, for different people. Maybe it could be too early. Maybe, advice might have a better sitting with somebody later on in life, or, in a few years' time, or maybe there's, things to get through before then, or maybe it's important to get a run up on things that are going to happen, in which case advice can be worth way more bang for buck for somebody at that point. So a 15-minute intro chat is where it starts, and that's where we sort of get a feel of where you're at and what value advice could be.
Yeah, that's a good one. Now, I did say this for near the end because I can't help myself. Let's talk to the doomsday people. Let's talk to the people, who start to have a negative assessment of, economics and where we're heading. Some people would be interested in owning physical gold, or, they talk about the cashless society and the negative direction that we might be heading in as a whole. Yeah. What would you say to people? Because I know personally, after the GFC, you can see where that fear comes from. I remember looking at gold markets back then and going, man, maybe I should put all my money into gold. Yeah. Thank God I didn't, because property was still a very significant asset back then. Yeah. A very sound investment choice. But, I have watched gold from, back in the GFC days to now, and it's seen, tremendous rise, especially in the last 10 years. You've seen gold really take off as an example. Yeah, precious metals would be something a lot of people would be considering. What's your take on this? What would you say would be a responsible attitude towards things like physical gold and things like that?
Yeah, that's a really good question. It does come up more and more now. I think a gold price that's gone vertical is probably the reason for that. Silver as well. But I guess, to answer questions, I zoom out a lot back to the concept, I guess, and that gold has been money for about 6,000 years, and it kind of still is. There was a period of time in the 1900s where world currencies were pegged to the US dollar, and then the US dollar was pegged to gold. But that was an arrangement that fell over, and that's when the gold price, I guess the US dollar, was floated in 1971. And from there, gold priced in US dollars has basically gone up, ever since, which says more about the US dollar, I think, versus gold, because I guess 1 ounce of gold has always been worth 1 ounce of gold. There's a couple of different angles to think about. 1 ounce of gold about 200 years ago could buy you a night in London's finest bed and breakfast. Yeah. I guess the same could be true today. 100 years ago, an ounce of gold could buy you a decent horse for work on your farm. Today you could probably say the same thing. I got you. $5,000-6,000 might get you a decent horse. So in terms of value over time, gold has the deeper track record versus government currencies. Yes. But I guess, speaking to the doomsday part, it just seems like increased government surveillance is probably like the underlying, the undercurrent there. And it's real. I mean, you can go down a YouTube hole and find whatever you're actually looking for, or something that will agree with the way in which you wish to think. But yeah, it's a real thing. I'm meeting people that have, I spoke to a couple last week that said they dug a hole in their backyard and buried like 10 kilos of silver in there. And I freaked out because I said, make sure you tell like somebody else that it's there.
Yeah, of course.
Don't just be the only ones that know about that. But yeah, then when the price went up, they dug it back out and, took it down to the local bullion dealer and made a trade, I guess, which speaks to the other thing as well, is that precious metals don't generate an income. They're not an economic good. Yeah. They're a monetary good, I guess, at the end of the day. And so to benefit from that growth in the price, you have to buy and sell it, which is a capital event. There's tax involved, costs as well. Bullion dealers take a decent spread on the costs. Yeah. There's lots of angles to it, but I guess, people that are buying gold, silver, precious metals, I guess in their minds, they're trying to protect their purchasing power over time, which I guess, and there's growing distrust in government currencies. If those currencies end up floating themselves on blockchain rails, which is the tech that a lot of central bank digital currencies are being built on around the world, there is a worry that they'll have programmability over those dollars.
Gotcha.
Which could be a good thing. I mean, from a taxpayer's perspective, money that's given to people that need it, like social security and income support. Ideally, it's spent on supporting themselves and their lifestyle, not gambled away, say, in pokies or something like that, or taken to the track. So maybe there's an angle to that. But there's definitely two sides to that story. Those people, might think, well, I've paid my taxes all these years. I get to live my life the way I want. Like, don't tell me how to spend my money, sort of thing. So it'll probably get more heated as, the politics continues on that. But I think the general worry is that it's government overreach and perhaps that programmability in government money or blockchain, central bank digital currencies will lead to more surveillance and more control. I think that's when you go down the YouTube hole. I think that's probably the concept that's sitting at the bottom of the hole, which I know could have some logic to it.
Well, I was gonna ask, like, if you deal with all types, people are looking for a balanced approach to things. If someone said to you, "Look, this is a consideration for me," the ESG aspects. I want to be doing what I can to help affect change in the world. I want to make sure that I'm looking after myself, my grandchildren, and taking care. But I also want to have a little bit of a hedge in case, the world turns into a tyrannical hellscape. Could you, from a professional's perspective, say, I can help you balance all of those things?
Ideally, there's a solution for most problems or preferences, I guess, out there. Look, precious metals is probably an option. How do you hold that in a particular vehicle can depend, on what it is. How do you hold it in super? How do you hold it in, in a hole in your backyard? There's a few questions. I guess also, like a good advisor who is on your team would maybe ask the questions. Why? Going back to the why. Why do you think that's a problem? There is economic trends that would suggest it's not silly to think about that sort of thing. Things like demographics and sort of shrinking tax bases for aging populations and things like that. Governments are going to have to find money. How do they do that? They might need to control behavior or incentivize different behavior so that, their plans for supporting populations through that period of time can work. So that there's logical angles to it.
Mick, I got to say, it's really interesting talking to you, and I appreciate your time today. It's Mick Simmons, Gradient Wealth. You want to drop that website address again one more time? Absolutely, gradientwealth.com.au. You can jump on, book a time, we can have a chat, go through things in more detail and see if, financial planning, financial advice can be of benefit to you. Yeah, that's great. Well, mate, again, thanks a lot for coming on, and cool. Mate, I wish you well. Yeah, thank you, mate. Cheers.